Hey everyone, Couch Investor here with another video for you today. Today I'm going to go over a game plan on how to get rich during crises and times of uncertainty such as trade wars, health crisis, financial crisis, maybe a recession as well, or just market crashes in general. We're going to go over stocks that have fared very well during this market crash, stocks that I own as well, such as Twilio, Illumina, Tesla, Shopify, you name it. We're going to go over the S&P 500 over time, see how that they have fared and why you should have bought some of the dips. We're going to go over a couple of points that will be very helpful for beginners and people that are generally stressed during those times of uncertainties. Before I begin, if you haven't subscribed to my channel, please help me get to 500 subscribers. We're almost there, so hit that subscribe button. And if you like the videos, consider leaving it a thumbs up. It really helps me out. And guys, if you have any questions about anything on the stock market or just your feeling in general, consider leaving a comment down below. I will most likely get back to you in the first couple of hours of releasing this video. So without further ado, let's dive into this. All right, so number one, be the 1%. All right, don't think too much about what everybody else is thinking. Don't read all those articles on MarketWatch, Yahoo Finance, or your Google articles or whatever. Obviously, do some research on stocks, but don't read too much in articles. Those are especially made for people that have no clue what they are going to do with their money or their investments. They don't care if you lose money or you win money. They just want you to click on that title that says, "Don't invest now. An analyst said the market could crash another 40% looking at the tech bubble," for example. Those articles are made for you to click on, and the people writing those articles, etc., are making money just by you reading the article, clicking on the ad, etc. All right, so one important point I want to make, it's going to be point 3, is portfolio consolidation. Now, what does that mean? It's basically you have your investments already in place since 1 year ago, 2 years ago, 3 months ago, doesn't matter. You already have your portfolio in place. Now, in times of uncertainty, probably some of your positions aren't relevant anymore in your current mindset. What do I mean? Maybe now there are stocks in the market that are extremely cheap that you did not want to buy beforehand because, well, it was too expensive. That's why you decided to buy stock number 1 and passed on stock number 2. Now, maybe now stock number 2 is way more attractive than stock number 1. So what do? You consolidate your portfolio. You maybe sell a couple of positions here. You have some cash and you open a position in stock number 1. Now, another point I want to make here is a lot of people say cash is trash. All right? Cash is not always trash. Yes, cash is trash if you don't do anything with it. Now, Mark Cuban said a couple of years ago, I think, after the Dallas Mavericks, in an interview after the Dallas Mavericks won the championship.
Second thing you do is you use the transactional value of cash. A lot of people say, you're losing money to inflation when you just have cash in the bank. I completely disagree. I know I'm going to be buying a bunch of toothpaste for my family. I know toilet paper. I know all the consumables that I have. I can take my cash and go get a better value. I can take my cash and go buy service.
Store up?
Yeah. Yeah, why not? I mean, how much space does toothpaste take, But
in times like this year, we had a bull market for over 10 years or so. If people had kept cash each year on the side and did not listen to people that said, "Oh, cash is trash," those same people will have a huge cash pile to have invested in stocks that have dropped 60, 70, 80% in a couple of weeks, would have made probably 100, 200% on their investment already to this date. I will show you 3 to 4 stocks in a bit. So that's point number 4 about cash. Point number 5, bottom catchers. Stop trying to find the bottom. The only thing that will happen if you try to find the bottom is you're probably not going to find it. You're going to lose money. You're going to lose even more money than if you bought at the price you thought maybe is reasonable for you at that time. People try to catch the bottom because, well, they say, oh, I don't want to buy, let's say, Facebook at $150. Oh, it will certainly go to $100. Okay, they wait, it goes to 140, 145. No, it will certainly go lower and lower. What happens in the next couple of days? Oh, Facebook goes up 160, 175. Those same people will buy the stock at 175. What will happen days after? The stock will probably fall down back to 150 because it went up too fast. Those same people got wrecked. They sell their position. They lost money. Stock rallies back to $200. What happens? Those same people buy again at $200. That's what I want you to put in your heads. Stop trying to catch the bottom of a market or a stock for that matter. If the stock is reasonably priced for you after you've made your own research on the stock, buy it. If it goes back lower and you have cash on the side, you add again. Dollar cost averaging is really the best way. Well, for me it worked to invest in the market. If you want to try to catch the bottom, good luck with that, but you're probably gonna get wrecked. Next point number 6, is it's all a mental game. Everything happens in your head. From reading attractive titles, from reading non-informative articles, from looking at YouTube videos, maybe just like this one, from not doing enough research, from doing too much research, everything at the end of the day is all in your head. You bought a stock at $200, the stock the next day crashes to $180. Yes, you've lost $20, but in your head, you're like, oh, maybe it will go lower, I will lose even more money. Think about what you thought before you bought the stock. Did you buy the stock because you thought maybe in 2 to 3 years that stock would reach that price, that company would have X amount of earnings, X amount of revenue? If so, don't panic. Maybe consider buying again. Cost dollar averaging. Instead of panicking, calm down, look at your logical reasoning you did before you invested your money. Obviously, not all stocks are worth having during a crisis. Some stocks will go down and will never go back up to their all-time highs. That will be my next point. All right, so I'll continue with this. Next point is not every stock that goes down necessarily has to go back up again. I will show you a little clip about Peter Lynch.
I understand the company, you have this problem when they go down. Eventually, they always come back. This one doesn't work either. People think RCA just about get back to its 1929 high when General Electric took it over. A lot of double knits never came back. Remember those beauties? Floppy disks, Western Union. The list goes on and on. People saying it'll come back. Well, it doesn't have to come back.
I've seen a lot of people think that if you buy a stock that's at $100 and it was at $200, that means the stock most likely will go back to $200. Wrong. A stock that was at $200 and is now at $100, there is probably a reason why it's at $100. Yes, it could be a market overreaction like we've seen in the last couple of months. Solid companies get their prices cut into half. Those companies, yes, will go back up. But some companies weren't even healthy before. They were just at that high price because the whole market was rallying. There are a couple of companies, even, I don't know, specific ones that I can name besides the ones that Peter Lynch talked about, that just dropped from 200 to 100. And then people buy at 100 just because they've seen that the price went to 200 a couple of months ago. No, that stock can very well go back down even more. They could go back down to $50. That's the price they were a couple of years before. If the company is not solid, if their balance sheet aren't a solid balance sheet, there is no reason for that company's stock to go back up to its all-time highs. Besides a market rally, a bull run, like we've seen in the last couple of years, companies like Boeing went up to over $400, even though their planes were crashing, their planes weren't even functioning correctly. Now they're in a huge, cash problem. Yes, they got money from the stimulus program, etc. But for me, $400 shouldn't be a price that Boeing will go back to in the next couple of years, unless they fix their balance sheets and their debt. That's that. Let's move to the next point. All right, now I'm gonna go over the graph, this one right here, and over a couple of stocks that performed very well during times of uncertainty. All right, so let's start with the SPDR S&P 500 ETF Trust, started in 93. This was the dot-com bubble. If you bought all the way down, a bit here, maybe even at the bottom, you would have made solid investments, and your stocks, your investment will have been solid for the next couple of years when it went back up to its all-time highs back then. But what happened then? Financial crisis. What you do there? Same thing, rinse, repeat. You buy when it goes down, obviously. Dollar cost averaging works perfectly. If you're lucky, you could have caught the bottom, but we don't try to catch bottoms here. Then you go on a 10-year bull run until you reach a couple of bumps right here. This was Donald Trump's presidency start. Again, same thing. You can buy the dip if you have cash on the side. That's why I said cash isn't necessarily trash. Now you reach let's put it on the 1 day. You reach the trade wars like you've reached, well, we're about to reach again. Trade war, same thing. In a matter of weeks, the market tanked. What you do, if you bought all the way down, and even when it recovered a little bit, you can always buy when the market recovers a bit, so you have a better overview and better view for the future. You would have made perfect investment right there. And then this is our situation right now. All-time high, $338. If you bought, let's say here, you buy here, 271, 243, 237, and 220. That's the lowest point. And then even when it goes back up again at 250 or so, you keep buying to have a good average in the overall picture. And then when it goes back to its all-time high, you will be even better positioned than you were before. Now let's look at a couple of stocks that performed very well during these times. Now this is a stock I talked about in one of my recent videos. It's Illumina stock. As you can see, the stock is well over its all-time highs before the market crashed. If you bought down here 290, if you bought down here 260, and even the bottom, and even when you went up, from the bottom to the top is 80% gains. Obviously, if you bought and dollar cost average all your way down and a bit on the way up, you would have made, I think, roughly 40, maybe 30% gains for sure. That's how smart people make money during a stock market crash. Now, one of the most talked about stocks in the world is obviously Tesla. As you can see, the stock went all the way up before, and even when the market started tanking to over $900 or so, then it went all the way down to $350. Now, some of you might know, I bought the stock back in 2019 at 186, sold it at around here, $903, and then I bought it back at around this time right here. I did not, well, my cost will be around 600 and so. I did not try to catch the bottom because that's not how I play. I bought a bit when it went down. I bought a bit when it went up. So I'm certain my average for that stock will be great as well. As you can see, the stock is almost back at its all-time highs. Those are innovative, disruptive stock that will probably perform much better than most stock during market uncertainties. Another stock that has done, well, fairly well is not doing justice to this stock is Shopify. From its lowest point during the crash at, let's say it was at 300 or so, until now it would have gained 173%. Now same thing, let's say you bought the top at 590 before the market crashed, and then you kept on buying all the way to the bottom and a bit when it went back up, you probably would have had an average of something like this. Still 72, almost 73% gains. Why? Because those are the types of stocks that hold well during a market crash, because those are the type of stock that would have anyways go up in the long run. Sometimes a crisis helps innovative and disruptive stocks move much faster on its way up, like with Twilio. I will show that right after this one. So Twilio stock, I've made a video about this as well. As you can see here, went all the way up to over $200. What happened? The stock would have eventually reached that price tag maybe in the next couple of months or next year. During a crisis, some companies with a brighter future have their, let's say, goals reached much faster because, well, now everybody wants to work from home, has to work from home. Companies move to tech, even though they would have planned on moving to tech in a couple of years. They move it much faster because of the current situation. As you can see here, lowest point was what, $70. In a matter of 2 months, the stock is at $200. If you've bought the top, let's say right here, that was last year. This year was $130. If you bought all the way down, you would have doubled, maybe tripled your money. Now, lastly, a stock that is very popular, it's a website building stock, Wix. Same thing. A lot of people are working from home. Lots of people are probably creating websites, maybe e-commerce website, etc. That's why a company and a stock like Wix, innovative, disruptive stock, went on and has risen to over maybe, probably doubled and more since its bottom in mid-March. Same thing here. If you bought the top before the market crash at 151, you would have made a significant amount of money since then. To be more precise, 38%. Now, if you would have bought the bottom, or maybe cost average down, so it would be around right here, 84% gains. That's what happens when smart people invest in the stock market. When everybody is fearful, you have to be greedy. Right, and lastly, very important is be greedy when others are fearful, and be fearful when others are greedy. That's the number one rule. When everybody thinks the market is going to go down even more, that's when usually the smart people are buying the stock. When people say the stock will go back up even more and more and more, that's usually when smart people start selling some of their positions. Now, this will be all for this video. Hopefully you've learned something. If you liked it, please leave it a thumbs up, and if you haven't subscribed yet, hit that subscribe button. It really helps me out. If you have any questions, leave it down in the comments below. I'll always answer your comments. Guys, take care, stay safe. See you all in the next video. Bye bye.